very closely so that way we can get through all the information today. And then what we're going to do once we have our lunch break and everybody settles in with your food in this room, I'm going to bring the lenders back up front and then you can ask all the questions you want at that point. So please write down any questions you have as you go so that we can get those answered at the end. And you will see there is a break in the schedule there as well. That way you can have a potty break and a bathroom break if you need one. The last thing I want to mention is the lenders that are here, the attorney that's here, I'm going to have a down payment assistance some people here. They're going to present on a specific topic, but that doesn't mean that that's all they actually do. They do a lot of different things, but I want to give you a wide variety of people to hear from today. And they're going to talk about a very specific thing for you, so that way you have some knowledge of that. But it is going to be kind of an overview. It's not going to be way deep in the weeds, because I feel as a real estate professional, we should stay in our lane, let the mortgage lender stay in their lane, let the lender stay in their lane, and then there's no accidents on the freeway. All right? So we need just enough knowledge to be able to talk proficiently to our client and then pass them off to a mortgage professional or an attorney for additional information. Everybody agree? All right, so I'm going to give you 30 seconds. I want you to introduce yourself to someone you don't know in the room and then come back to your seat. All right, so we're going to get started here. Heather is actually with Movement Mortgage. You'll find all these lenders, I've found, a lot of them have moved between companies throughout the downturn and some other things. So if I mess up where you are from, I apologize, because sometimes I know you from other companies. But Heather's currently with Movement Mortgage. She's actually the rep in this office. And Heather's going to talk to us about the government loan products today, some FHA, VA, USDA. Heather, take it off.
All right, perfect. So I'm Heather. However, that's not the case. FHA has very competitive rates. They have less stringent guidelines, low down payments compared to like your normal conventional type financing.
Sure.
Oh, there we go. So what we're going to be covering today, we'll be going over the FHA, the VA, and the USDA loan. So, does anybody know what FHA financing stands for? Woo, good job. All right.
Been studying.
FHA stands for the Federal Housing Administration, which is government agency by the U.S. Department of Housing and Urban Development, which is HUD. FHA does not make loans, it only insures loans made by an approved lender. FHA is one of the most popular types of financing due to the low down payment, which FHA requires 3.5% down payment. Low attractive rates. Sometimes you may see that they are risk-based pricing. So if you have a borrower that has a 600 credit score, they're probably not going to get the same rate as a person with 700 credit score. So that's called risk-based pricing. You're probably going to see that they're going to get a higher rate, or they might have to pay more in like an origination charge or something like that. Less stringent guidelines and credit score requirements. Movement, we go down to a 580 credit score on an FHA loan. So, with the 580 credit score, you're going to have some compensating factors.
Because it's specifically for doing a rehab. Like if you go into a house and it just is a mess, but they've got to have it. I mean, it's just their dream home. Mom lives next door, they've got to have this home. This might be the product for them. So tell us how this works.
Okay, so basically FHA is a rehabilitation loan. 203K is like an arm of the FHA, and it's for houses that are like been existing for at least 1 year, and it needs some work to be done. And there's two different types. There's a streamlined FHA 203K, and that's for stuff that has minor rehabilitation costs.
It'd be like carpet, paint, that sort of thing.
Yes. Mm-hmm. And stuff that is cosmetic in nature. The 203K full, you can add rooms to the house. You can anything that has to do with the structure, like you have to tear down a wall, for example. It's kind of like the base thing. Now, it considers the after improved value of the property. So the neat thing about that is if you have repairs that need to be done, you take the basic purchase price and you can add those repairs, and it adds to the appraised value, and your loan amount is actually based on the actual value, on what the house will be worth after all the work is done. And that's pretty cool, because you can take a borrower that wants, it's not an ideal house, but they want, like new carpet or something, and you can add that to the purchase price, and not to the purchase price, but to the value, and get actually a loan amount to cover that expense. And I'm going to talk about all the rules governing that through here.
And basically, the only other option they have is buy a house and put their cash into it. And
yes,
a lot of people don't have $20,000 to put into a house to fix the roof and any structural issues and replace dishwashers that might have been taken out by the previous foreclosed owner, things like that. So this is an option to let them finance the entire amount. Once it's nice and pretty again, what's it going to be worth?
And also think about the terms of the mortgage. You're still going to get the FHA rate, which will be 4% somewhat. And like it's very tough to get a home equity line of credit these days, or if we don't have the cash to put on a credit card, think of those rates. So, and it allows you to just come up with stuff.
So having a bit of knowledge about this makes a borrower feel comfortable with you and lets them know that you are going to have them in good hands. A jumbo loan is a loan that has a loan amount above $417,000. Jumbo loans, as a rule, require 20% down. There are exceptions to the rule, but when you're thinking about those numbers, think about 20% down as a rule, because people are going to ask you these questions. The definition of a jumbo mortgage, jumbo mortgages tend to have a higher credit quality but do not meet the guidelines set by Fannie Mae and Freddie Mac. Those are government agencies that have the rules of a conforming loan, so a non-jumbo loan. Fannie and Freddie make the guidelines for lending. When a bank goes above that limit into a jumbo loan, there is a lot more criteria that the borrower and the property have to meet. So the borrower is going to have very good credit. You keep hearing the word debt to income ratio. They're going to have liquid funds. They're going to have to meet the guidelines. That means they're not maxed out like an FHA financially, because it's a riskier property and a riskier loan, so therefore a bit harder to get. What I did is I have made flyers that give you a description of a jumbo loan in a defined manner, so that when a customer calls you, you can keep this in your realtor book and be able to give a definition of such. The interest rates on jumbo mortgages have always been 1/4 to 1/2 higher at least. On any loan you do, your interest rate is going to be predicated on your credit score. So again, jumbos are a little harder to get. Most jumbo products require a 720 minimum credit score. And if you have an 820, you're going to get a far better rate than if you have a 720. So it is a credit-based pricing. It's credit-based on qualifying. And your loan to value is going to be the third most important thing, okay? So there is something also called a super jumbo mortgage. And a jumbo mortgage is a loan amount over $417. A super jumbo mortgage is a loan amount over $650. So again, on this sheet I have both. Qualifying consideration will include risk, credit score. You will require multiple appraisals on most jumbo loans. Maybe they'll have an appraisal and they'll do something called a field review. Maybe it will require 2 full appraisals. So, like with many of these other niche products we're discussing today, I would leave yourself enough time to close this. 45 days would be ample. When you have a jumbo mortgage or any other type of mortgage, your success is going to depend on whether you get your borrower's documents to your lender or not. When we pre-qualify a borrower, we're qualifying everybody on verbal information. I make $100,000 a year, I have 3 kids, I only have 1 mortgage, etc. We pull their credit score. We can verify that there's only 1 mortgage showing on there, but we can't verify their income. We can't verify their assets, which means the amount of money that they have in the bank. We can't verify where their down payment is coming from. All of these things have to be verified before an underwriter will ever look at a file. On a conventional loan, they might let it go through a pre-underwrite. On a jumbo loan, you can bet they're going to double check and triple check everything. Many jumbo loans, and especially super jumbo loans, will not only go through 2 appraisals,
pushback farther than that, just because of legislative and realtors are giving a lot of pushback. Their whole concern was, if you're doing this August 1st, it's right in the middle of the buying season. And a lot of people have to get up to speed. Okay, we've got to get attorneys up to speed, we've got to get mortgage companies up to speed, Movement Mortgage, and I'm sure Fairway, we are all ready to go. We've got companies, we have departments that have been spearheading this since it even was announced. So you can rest assured that we're on top of it. Just a brief scenario about what the changes are going to be. I've printed out the PowerPoint that we'll just kind of briefly go through, and then I also printed out the new form and what it kind of looks like and what you'll need to be ready to go over with. Basically, the truth in lending, what this means is that, you know how you go to closing and you might be scheduled to close on Friday, but your package doesn't get there till Friday morning? It won't be that that will not happen. It just isn't going to happen. It has to be disclosed 3 days to the borrower, once again, 3 days prior to closing. So we have to go talk to them. The HUD is out 3 days, and then that's a good thing for the customer, because they can talk about what they're going to have to bring to closing, if there's an issue with the commission not being right on the HUD, little things like that. But it'll be imperative that you have made sure that all your invoices, anything like that that could change the HUD. There are things that don't trigger a problem with the HUD, but you don't want to have it, you don't want to not be sure. You want to make sure you have your surveys, all of your invoices to your attorney way before that gets redisclosed to the borrower those 3 days. So
because if it gets redisclosed, like if there's a change, what happens then?
You have to wait 3 more days.
If you're closing Friday morning or Friday afternoon,
you have a change on Thursday and it was closed to bar,
you're not closing that week.
So this will trigger, we call it trigger, this will trigger a problem with another closing. I mean, a lot of us have closings that are back to back to back to back. And you've got 4 closings because there's 4 houses involved in a sale or hunt. So you want to make sure that you're partnered up with the right people that are going to manage through this. It will also mean that we have to make sure that our attorneys are partnered up and know, we're all partners. We're all going to be managing this, new regulation. But don't let it scare you. The only thing I want to start out with before this is don't let this scare you. There's a lot of people that know that it's scaring you. There's people, I've been to a couple seminars with attorneys, and the way they put it, it makes all the realtors just go, oh my gosh, the world is ending, the chickens are flying. I mean, it's horrible. It's going to be okay. It's going to be a 6-month process for everybody, but we'll get through it. So just be prepared to communicate. Communicate with your lender, communicate with your attorney, communicate with your borrower.
The DC area, in Virginia, West Virginia. I haven't personally had anyone that had been before. It's the thing that could be common, okay. So secondly, the next thing that I have is we have construction loans. My biggest niche product is I can do a 5% down construction loan. There's a lot of pluses to our construction loan. It is a 2-time close, but
Explain what that means first.
the client closes on their construction loan and they have 12 months to build. And then when we're about 60 days out from closing, we're going to start updating documents because we underwrote and qualified them to their permanent financing up front. But they are going to have to go to closing again to close on that permanent loan. But the attorneys and stuff, the only fees they're paying for on that permanent loan though is attorney's giving them a reduced fee because he's already done the title work once. And all he's got to do is update the title, and then they get a reissue title on the title. So there's not any lender fees. So their fees are greatly reduced. The biggest cost in that is setting up their escrow. Because we're going to take that appraised value now that they built that house and go off the tax records or the tax rate for the county. And sometimes it's a little above what it would be, and it's going to get a refund. But when you're in new construction like that, the escrows for taxes are never right for the first year or two. Until the county gets out there and assesses it and puts their value on it. And I've never seen the county come in as high as what the appraised value was yet. But, so that means very rich are going to get a refund. But our construction loan, another great thing about our construction loan, we will loan off of a subject to appraisal. So when my client comes to me and he's got a lot contract, he's got a contract with a builder, that together is his acquisition cost. But the appraiser's going to go out and he's going to appraise his house as if it's already built. I've had numerous clients that have been able to pick up lots, put their deal together, that they actually had instant equity. So I've had clients that basically got 100% finance. All they came to closing with was the closing cost. But if the builder wrote into his contract, I'll pay your closing, but we front those closing costs on the construction, so you literally could end up building a house without any money out of your pocket. I got 3 going up in Davidson right now that they came in with 20% equity over and above what they bought their lot and got their bill for. So it's a really good thing.
Take a look at it, and I look at it and I'm like, absolutely not. That's not going to work, because the statute actually sets out, and this changed in 2010, I think, is when the homeowner act came out. I think it's 2010. And the statute 47G came out, and it sets out exactly what needs to take place and what needs to be within the actual agreement. And then thank you. Because I think you got, well, one, the good thing is now you guys, by using this, and this is another reason why I wanted you to have it, if you go to an attorney, and it's not me, and they draft you a lease purchase agreement, so if you're working on one right now and you got an attorney who drafted one, all right, you guys can take this form, and on the bottom of page 1, you see 47G-2, minimum contents of an option contract. All right, so you guys take the form that you guys get from the attorney and run through exactly what needs to be in there. And if it's not in there, I would probably say, no thanks, Mr. or Mrs. Attorney, I'm going to go somewhere else, because they should know that that's supposed to be in there. But it gives you guys a chance to kind of do your client a favor and compare any document that you get from the law office to make sure that it is in compliance.
And then sometimes I've seen investors come in hand a lease purchase contract.
A lot of times.
So that would fall into this too.
That's correct. That's correct. So you guys, that way, keep this, because I mean, it's a checklist for you guys to have, and kind of a general overview about lease purchases. And sorry that you're dealing with one right now. We don't like them. As attorneys, we, actually probably, once all these changes started happening, there's quite a few attorneys out there now that won't even do them. We will do them.
It changes. It changes constantly because it depends on when there's money out there that's available from one of our partners. So the Homeownership Affordable Fund, it's up to $1,500. It is provided, it's funded by Fifth Third Bank, and there are certain areas that you can use this fund for. It is a forgivable loan, which is, you know, that helps, and it's after 10 years, it's forgivable. And then the next one that we're going to talk about is, and this one is dealing with people who may be purchasing in the various area. It's through the city of Kannapolis, and it's a down payment assistance where someone can get anywhere from $5,000 to $10,000, depending if they purchase within the city limit of Kannapolis. One of the criteria, it must be 80% of AMI. The other program that many of you all may be familiar with is House Charlotte. And House Charlotte is where you can get anywhere from $7,500 to $10,000 as down payment assistance. Now this loan, again, it is a loan initially. It is forgivable, and it's forgivable after 10 years. It's forgivable, and it is, in order to qualify for this particular down payment assistance, you must be at 110% AMI. And what is AMI? Who wants to help me with that? Area median income. Thank you, thank you. So again, it is area median income. So when you hear that terms, and I'm sure as realtor, you'll probably hear that quite a bit. The other thing that the House Charlotte, you must purchase in designated areas only of the Charlotte area. So keep that in mind when you have customers that are looking. In order to get this down payment assistance, they have to purchase in those areas. The other one that you have on your sheet is the Neighborhood Lift Program. And this is, again, it's up to $15,000, and it is a forgivable loan. And the AMI is up to 120% AMI. You must purchase within the city of Charlotte, and this is offered only by certain banks. And you have the Wells Fargo Bank, you have Bank of America, BB&T, First Citizen, or Fifth Third. So those are criteria. In order to get this money, you have to go through these lenders. Of course, I just want to let you all know, we are not endorsing any of these lenders, but in order to get that money, your customers will have to use one of these banks.